Hi everyone, welcome to part 3 of interest calculations. I felt it important for me to do this series because a lot of us take debt, as I mentioned, and we don't know how interest is calculated. So what I really wanted to do was to discourage you to take unnecessary debt. Also, you're going to also get to see how financial institutions make money. So we should actually be taking up debt in order for us to buy assets and build wealth, right? So I'm going to show you how, interest payments, you're basically handing your money over to somebody else in order for them to build wealth. I did mention this in the first video, so please do watch all 3 parts for this entire series to make sense to you. So it took me a while to record this video because my calculations on Excel compared to the amortization schedule that I showed you in part 2 and my financial calculator, so those two agree, but my calculations are like off, but it's by a small margin. So please focus on the principle, or rather the formula that I'm going to show you, instead of getting the numbers right or the numbers to balance. I remember we used to struggle with this in accounting, where we wanted our balance sheet or whatever it was in accounting, balance. So just don't focus on the actual numbers, just the principle. But also, the reason why they might not be balancing is because there are so many it is so amazing what decimals can do to actually increase an installment. So you'll find that the bank or the amortization schedule that is used and the financial calculator, it takes into consideration a whole lot of decimals, in which I only use 2. So I think there's like a 70 rand difference between my calculations and the financial calculator and the schedule. So we're still continuing with my home loan example for this to all make sense, all 3 parts to make sense. In the amortization schedule that I showed you in part 2, I showed you the interest charged column, and I showed you how interest is charged on a monthly basis. So today's episode, we're just really going to break it down to how it's calculated per day, right? Because if you remember, in the pre-agreement statement and quotation that I took you through, it said that interest is calculated daily. So it's important for you to see this daily calculation, right? So this is the amortization from part 2. Today our focus is on this column, the interest charged. So I did mention to you in part 2 that these interest calculations are the monthly calculations. And today what I want to show you is how this interest is calculated daily. So we're going to focus on these columns that I've added here, and these are the ones that I said right at the beginning of the video that my numbers are a bit off, but I tried my best. I was just so tired of cracking my head. But anyway, so simple interest calculates interest on the principal amount only. So what that means is that the opening balance in calculating this interest will forever be this interest amount, and then you calculate on the annual interest rate. But now to calculate it daily, just focus on this formula here. You need to divide it by 365 days in order to get the daily interest rate. The interest calculated for that month is 7,953 rand and 72 cents. Now what's interesting is that in real life, in our real world, everything is calculated on compound interest. Simply put, this means that your first amount will be your loan interest amount. Then you calculate the interest charged on that particular day. Excuse me for that. Right? And then the closing balance will be the opening amount plus the interest. And then the opening balance for day 2 will be this closing balance of day 1. So on day 2, interest is not going to be calculated on the principal amount. It's going to be calculated on the new opening balance. So this amount, you see that there's a 7-cent difference between the two amounts. And then when you add this to this opening balance, you get that amount. And so it continues for the duration or the term of your loan, right? And this is and interest is calculated daily and capitalized monthly. So it means that at the end of the month, you then pay an installment, and in that installment, most of it is interest, and the other portion is capital paid. So once you start paying capital, whichever day of the month you pay, makes a difference. It matters. So whether you're paying on day 1 or day 2 or day 10 or 16, it matters. If you pay towards this loan on the 16th, there will be a new balance, a reduced balance. So the idea is for you to pay earlier, sooner rather than later. So as you can see, the interest charged increased daily, and it's added daily. So what I wanted to show you, and I said please focus on the principle, is that the simple interest charged is lower than the compound interest charged. So it is important for you to know that the real world uses compound interest. It matters on which day you pay towards your loan. And if you miss a payment, that amount is still compounded. So if I decide that I'm not going to pay this installment on payment number 2022 on my loan, this amount will be added to the opening balance and calculated, and interest will be calculated on that higher amount. So for each day that you're not paying, as I mentioned, you are going to pay interest on interest, right? This also applies for payment holidays. So if you're not paying, the amount doesn't just sit still and you're not paying, what you pay for that, for having that holiday, is more interest, and it's compounded. And then those deals where you get this a lot, like in December, because they know that we spend our money on holidays and Christmas and so forth, right? But you get deals where they say buy now. I've seen a lot of car advertisements where they say buy your car now and pay in 3 months. So when you are not paying the 3 months, you are being charged compound interest. And the same applies for residual and balloon payments. That balloon payment is not just sitting there waiting for you to pay for it. It is attracting compound interest. But the good news is that compound interest is also applied on your savings and investments. So ideally, we should have savings and investments in order for us to borrow money from ourselves and pay ourselves back, instead of borrowing money from financial institutions and paying them back and making them wealthy. So yeah, I really do encourage you to save and invest for you to, to have your assets paying for your liabilities. I hope I've made you more aware of what interest does to your pocket, and I've also encouraged you to save more money because of compound interest. So please focus on the debt that builds you, that helps you create wealth, right? So to support my channel, please subscribe, like, comment, and share with your friends and family if you like this information. And remember, the power is in your pocket.